Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, I want to thank each and every one of you for attending today. I know that this is a hot topic. We always kind of laugh that it is tax season from about February 1st on, and we consistently receive a lot of questions regarding the tax benefits of long-term care. With that, I know recently we have launched our tax guide from here at Premier, but I thought today would be a great opportunity to have Mutual of Omaha, one of our top-selling long-term care carriers, go through the discussion of the tax benefits. With that, we have two of our specialists. First off, our regional of sales, Amanda Blackburn, and then we also have advanced market sales with Stephen Alloy. So with that, would you guys like to kick us off with some of this discussion?
Yeah, thanks so much, Katie, and thanks for having us today. Happy Tuesday, everyone. I want to, again, also thank everybody for taking time out of their afternoon to join us. Stephen and I are excited to be here with you today. As Katie said, my name is Amanda Blackburn, and I'm one of three long-term care sales directors at Mutual of Omaha. First and foremost, I just want to share a friendly reminder for those that are registered and in attendance on today's call. Your name will go into a drawing to win a Mutual of Omaha logo item from our corporate collection and a Wild Kingdom item. So for those that submit a long-term care app and that have an app issued within 90 days, we will also be mailing you a one-time $25 gift card. So good luck to everyone on the line, and again, thanks for joining us. I would also like to thank anyone on the line that has written a long-term care policy with Mutual of Omaha. We appreciate your business. If you have not, I encourage you to work through Premier Marketing to get contracted and licensed to write with us. There is no better time than now to be talking with your clients about long-term care insurance. Our recent pandemic has created a level of awareness for many that was not there before that can now see the value in having a long-term care plan in place. So if you're not having those discussions, I encourage you to do so. I will be partnering with Katie throughout this year to bring you more webinar trainings that will focus on the value of traditional long-term care insurance and sales opportunities that will help you bring financial peace into more clients' homes. As a mutual insurance company, we are owned by our policyholders and guided by our noble purpose to help our customers protect what they care about and achieve their financial goals. With that, our trusted brand helps us attract, acquire, and retain customers, and our strong financial ratings strengthen our competitive position. So as we kick off 2022, we have a streamlined focus on growing and technology modernization. So those are just a couple of things that you can look forward to with Mutual of Omaha. We are a 113-year-old company that plans to be around for many more years to come. There are a lot of advantages to owning a traditional long-term care plan. There is a no one-size-fits-all solution when it comes to buying long-term care insurance. So if your clients are looking for a way to remain in their homes as long as possible, ensure they won't have to rely on their kids to take care of them, and looking to protect their retirement nest egg, traditional long-term care insurance is most comprehensive solution and has the flexibility with the Mutual of Omaha long-term care policies where you can dial into any price point your clients can afford. So remember that some coverage is always better than no coverage. In addition to these advantages, there is another important advantage, and that's why we're here today, the potential to save on federal and state income taxes. And that is what we want to review with you today. I would like to welcome Stephen Alloy, our Advanced Market Specialist, to share these advantages with you. Once Stephen concludes with his portion of the presentation, I'll go ahead and wrap up with a few sales ideas you can walk away with today to start building your long-term care book of business. So with that, Stephen, take it away.
Hey, thanks, Amanda, and thanks, Katie, and thanks everybody for calling in today. I appreciate the opportunity to talk to you about really, I think in a lot of ways, the darling of the tax benefits in the insurance world is long-term care insurance. As you see some of the scenarios with long-term care, tax benefit, it'd be hard to imagine better tax benefits than some of the scenarios that we'll talk about today. You're probably all aware of a lot of the tax benefits, but hopefully you'll get some ideas and maybe some information from this that might give you ideas on people to talk to that could benefit from some of these tax breaks that we'll talk about. Of course, long-term care generally tax-wise is treated as accident and health insurance. Is those of you you're probably all aware of that already. There are tax benefits available to the employers through that treatment. And the nice thing is that, at least under current law, there has been talk from time to time of changing this. It doesn't count as an income to the employee, so it kind of works nicely both ways. Policies that came into being since HIPAA, which of course was, as you can see there, is January 1st of '97, are what are considered qualified long-term care contracts. So they contain the tax benefits that we're going to talk about today. Policies issued prior to that time, as long as they were in compliance with state laws, most of the time they have these same tax benefits as well. I mean, there were a few that maybe didn't make the cut, but by and large, a lot of them have the same tax benefits as well. So probably the biggest question that we certainly in advanced markets get, and probably a question you get with meeting with a lot of clients, is, can I deduct this? Generally the answer is yes, but kind of depends on how you're filing taxes, what entity you are, and whether you're a business owner or an employee. So we'll talk a little bit about all the different permutations, because it's different for businesses, different for individuals, and different for employees that have the benefits provided. I'm going to start with the eligible premiums here, and this relates specifically to business owners and their deductibility. This comes into play for the most part with them. As you can see, the numbers on the left are for 2021. So the taxes that people are filing now, as Katie said, this is indeed tax season, and people are filing their taxes. The deductions that they can take in many cases is going to correspond with those eligible premiums. And of course, they're age-based. Each decade, you can deduct a little bit more. For 2022, for people just starting policies now, or if they're looking forward, looking ahead to next tax year, those numbers would apply. And you can see they really didn't change too much, although for whatever reason, the eligible premium for age 61 to 70 went down $10. I don't know that I've ever seen it actually go down in the past, but for whatever reason it did this year. So the eligible premium is a little bit, slightly lower for that age group, but otherwise they stayed the same from 21 to 22. So for individuals, individuals can deduct the actual premium, but they can only deduct it as part of medical expenses. So they have to combine that with all other medical expenses that they would have in the course of the year, all the other deductible medical expenses. And then they would also have to itemize on Schedule A of their taxes, assuming they're filing a 1040, to itemize on Schedule A. And they can deduct, let me back up. They can actually deduct the amount up to the eligible premium, not the actual premium. I'm getting a little ahead of myself thinking about C corporations here, but they can deduct the amount up to the eligible premium. Now, that's a good deductibility for individuals, but and this is just a copy of Schedule A. It's a good deductibility for individuals, but okay, I guess the other shoe is that with the tax bill of 2017, the standard deduction, at least for a period of years, went way up, and a lot of the deductibility for other things, not specific to long-term care, but a lot of other deductibility went away or went down. So what that means for deducting long-term care is that, because it has to be part of medical expenses, and because an individual would have to itemize on Schedule A, with a standard deduction so much higher, it doubled basically, and it's going to stay that way through 2025. So the taxes people are filing in 4 years would be the last tax that this would apply to, at least under current law. With the standard deduction that much higher, many fewer people are itemizing on Schedule A. They're itemizing deductions. Most are just taking the standard deduction because, you know, they, even if they go through the exercise of counting up the itemized deductions, it's still lower than the standard deduction would be. So the Joint Committee on Taxation estimates 9 out of 10 use the standard deduction. I would say it's probably somewhere between 9 and 10. I think it's even higher than 9 that use the standard deduction. So it is, the premium is technically deductible, but a lot of people aren't really reaching that standard. And then of course the medical would have to equal 7.5% of adjusted gross income, which, you know, for some people is a challenge. Frankly, for those of us with families and kids and everything, you know, that's usually not that hard to get medical to that expense, to that level. But for a lot of people, that would be a challenge as well. So yeah, technically deductible, but a lot of people may not see the benefit, may not be able to use the benefit on their federal taxation. Business owners, very different story. Business entities are treated a little bit differently as far as deductibility, generally based on whether they're C corps or not. So there's essentially C corps, and they're what under the tax code is called self-employed. It's basically everybody else. Everything that's not a C corp is treated as the self-employed. So since that's the bigger number, let's start with them. So who is self-employed? Well, if you're a sole proprietor, if you're a partner in a general partnership, if you're a member in an LLC, long as your LLC is not taxed as a C corporation, which, you know, few are, but every now and again we run across one that is, and there's some earnings from that self-employment, you're considered self-employed. For S corporations, it's if you're greater than 2% shareholder, you're considered quote unquote self-employed for this tax treatment. So what is the tax treatment that you get for the self-employed? It's treated as a health insurance premium and treated as income paid to the self-employed owner. However, it's deductible up to the eligible premium amount. So, you know, as we saw on the schedule of deductible premium of eligible premiums, the self-employed can deduct up to that amount. And the nice thing is it's deducted, it's not considered as part of their itemized expenses. They don't need to reach any particular plateau. Very unlikely that would be their only medical expense in the course of a year. But if it is, they could deduct it still. They would still be able to deduct it without having to, you know, lump that in with all other medical expenses. So, and this is how that would work on line 10 here. C corporations really are this is really about as good as tax benefits get. It's a C corporation. Hopefully, anytime you're talking to anybody that is an owner of a C corporation, long-term care comes to mind because it is C corporation structure in general is the best for expensing benefits, and it's far and away the best for long-term care. So who can deduct it? Well, anybody who's shareholders who are employees of the company, so they would have to be employees, but any of those employees, spouses, or dependents are able to deduct it as well. And what can they deduct? They can deduct the actual premium. They're not limited to the eligible premium. So if you have somebody that's got the, you know, the Rolls-Royce plan, well, if they're a C corporation owner, they can deduct the Rolls-Royce plan. Now, if they're not, if they're a self-employed, well, they can deduct the eligible. So if they're older and have an expensive plan, that they can deduct a little more, but C corp owners really get to deduct the whole thing. Benefits are still tax-free. So that's really about as good a tax break as you're going to get. You know, you're not taxed on the money that you use for the premiums, and you're not taxed on when, you know, if you go on claim when you take the benefits either. Long-term care insurance as a benefit is what we call selective benefit. Different employee groups can be carved out and the benefit can be offered to them. It doesn't necessarily have to be offered to everyone. They can. I mean, if they want to, that's great, but they don't have to. unlike say an ERISA plan or regular health insurance where meeting certain criteria they really do have to offer it to everyone. Long-term care, they do not. So having said that, though, I think it's important that any company work with their attorneys to make sure that they are complying and that they're not stepping over any line, any coverage line or ERISA line by offering this or offering it as part of what maybe a plan that has other ERISA benefits. So, but in general, employers can carve this out and can specify, I want to offer the benefit to these employees, don't want to offer it to these, and they're pretty free to choose who and where they use the benefit. The tax treatment for employees of any of the business types in some ways is the best, although the C Corp is pretty darn good. But if this is a non-owner, if this is just an employee of the business and the business is providing the long-term care, business can deduct the actual premiums, even if they're a quote-unquote self-employed business, an S Corp or an LLC. If they're doing it for a non-owner, they can deduct the actual premium that they're paying, and also they can deduct it for spouse and dependents as well. The employee that's not considered income to the employee. It's treated much like like major medical health insurance, not treated as income to the employee, and generally there's no out-of-pocket cost, and the benefits are still tax-free. So that's a pretty darn good tax treatment, and it's hard to imagine something better than that. So for the companies that offer this to their employees, it's a pretty valuable benefit. If you want to think of it in just even in tax dollar terms, it's a pretty valuable benefit. But certainly, obviously, if someone needs care, it's an incredibly valuable benefit. So the benefits, speaking of benefits, the benefits from qualified long-term care insurance are tax-free to the extent that they don't exceed the actual expenses, or for some policies that provide a cash alternative, or just provide money rather than that they're cash versus reimbursement. They can't exceed the per diem amount. Now, again, this is, I think, the first time I've ever seen this too, but the per diem amount for last year, the taxes people are filing right now, was $400 a day. For this year, it actually, because of that $10 drop in that one eligible premium, went down to $390 a day. So I really haven't seen an explanation as to why that happened, but it's pretty close, but it's $10 less for 2022. So as long as the benefits, if it's a cash advance or cash alternative, as long as it doesn't exceed that amount for whatever year the benefits are paid in, it would not be taxed as well. If it's more than that amount, and there are some, I have seen some hybrid policies that, or some chronic illness types of things that might advance in excess of the per diem amount. You may run into some taxation on that, but for most of the standalone long-term care, I mean, they're kind of keyed into either the reimbursement or the per diem. So probably not going to run into that much with those types of policies. So other questions that come up on taxes: can you pay the eligible premiums from a health savings account? Short answer is yes. If you have an HSA, somebody has an HSA or an MSA, they can pay the premiums from that. From a health reimbursement account, yes, they can pay the premiums from that. Oh, these answers maybe aren't as favorable, but if somebody has an FSA, flexible savings account, can they pay from that? No, because some of that money, and the same thing for the cafeteria plans, sometimes called Section 125 plans. Reason for that is some or all of that money goes in pre-tax, so they can't use pre-tax dollars to pay for something that might be deductible and provides a tax-free death benefit. I mean, that or tax-free health benefit. You know, that would be nice. That's a little further than they're willing to go as far as tax benefits. So you would have to use after-tax dollars for this. So 1035 exchanges are now allowed into long-term care policies. They're allowed by Congress. I believe this was the Pension Protection Act. Oh gosh, probably 2006 or so. It's legal. It might be hard to do because I don't think a lot of carriers are allowing 1035 exchanges from life or annuity contracts into a standalone long-term care. Reason they're not is that most carriers, I mean, I think there are a few that this wasn't an issue for, but most carriers weren't sure and ultimately adopted the opinion that 1035 into a lifetime pay wouldn't work, that a 1035 was more of a one-time event, and that doing a 1035 exchange into something that would ultimately be paid over a number of years wasn't a valid 1035. The IRS, well, I think the Pension Protection Act of 2006, I think it became effective in 2008 or 9. And the IRS at that point said, yeah, we're going to clarify that issue. Well, they must have had other things to do for the last 15 years or so, because they really haven't clarified that issue at all. So I think a lot of there may be some carriers that will do a 1035 exchange. There aren't a lot that will, unfortunately. So if there was a time, I think, where we had a single pay or a limited pay long-term care, that might be, if to the extent those come back, that might be an easier way to do it. Certainly if we have a single pay, I think the 1035 might be a real option with most carriers, but till that happens, I don't know that this is going to change much, or unless the IRS clarifies. So return of premium on long-term care. The return of premium, a lot of people ask, well, is that going to be taxable? It's going to be taxable to the extent it was deducted. So I guess the short answer is, if you didn't deduct any of it, none of it's taxable. But if you deducted eligible premium, then the eligible premium would be taxable. If you're getting the actual premium back but only deducted eligible, it'd be somewhat tax-free, somewhat taxable. So, that's something to, that people can watch as they're deducting, and maybe keep track of as they're deducting. Sometimes we get the question, can I gift long-term care premium? And short answer, yeah. You do have to follow a couple of rules, though. It falls under the medical care gift tax exclusion. And just not to go too tax code on you, but essentially you can pay someone else's medical care, and you're not limited by the $15,000 or $16,000 this year, $16,000 annual excludable gift, or even the lifetime gift. It's an unlimited amount, as long as it's directly paid to the healthcare provider. This is treated the same way. Long-term care premiums are treated as medical care gifted exclusions. So someone can gift the premium, and they can gift as much as they want, as long as it's paid directly to the provider, directly to the carrier in this case. And as far as if they're looking to make a deduction on that, it would only be eligible premiums that they could deduct, but they could actually pay without incurring a gift tax. They could pay, whatever the premium is. In addition to the federal tax benefits, some states, some states have some pretty good long-term care incentives. They give tax deductions. Some give straight out tax credits, which is a dollar for dollar reduction in the tax you owe. So that's, if you have to choose between a deduction and a credit, I'd go with the credit. You're likely to be better off unless the deduction is very, very good. So a lot of states provide that. I think the best way to see if your state does, I'm not familiar with every state. I mean, I know some of the bigger states do provide some pretty nice incentives, but the way to check would be to go to the AALTCI, the American Association of Long-Term Care Insurance website, and they've got a whole breakdown on all the state tax incentives around long-term care. Speaking of states, I'm sure everyone has heard about and maybe heard a lot about the program going on in Washington State. And I do need to update this slide because the taxation is now delayed until July of 2023. That just happened here in a couple weeks ago. For those that aren't familiar with it, Washington State had set up a law that provided some pretty basic long-term care, not a lot in the way of benefits, that was going to be paid through a payroll tax on all payrolls, generally all payrolls within the state. There were some exceptions, but and that was supposed to start January 1st, a month and a half ago. Well, there were some amendments that needed to happen to the law, and so actually the Washington State Legislature, the same people that passed this law not that long ago, voted something like 91-6 to put the law on hold. And it's the same people that approved it, just not less than a year ago. Put the law on hold, so they're not going to deduct from payrolls in Washington until July 1st of 23, at least at this point. And at that point, the implementation of it or the date to go on claim hasn't changed yet. It's still, I believe it's January of 2025. That hasn't changed yet, but that may be one of the changes depending on, if they need some more years of the payroll tax being collected. Washington is not the only state that's looking at something like this. There are several other states looking at it. So you may say, well, I don't live in Washington. Well, the state you live in might be one of them looking at it. I think this was a few months ago when this looked like this was going to go live January 1st. I think a lot of people were thinking, well, sometime this year, a lot of these states are going to jump in and do something similar. I got to think that that's probably on hold as well in a lot of the other states because, looking at most of the states, I don't see a lot of them saying, oh, okay, let me run to the front of the line and be the example. I think they want to let Washington do that. I think they kind of want to see what happens. So I don't think we're going to see a ton of, definite changes, definite moves in this direction until probably late next year, when, assuming the Washington law, that the payroll tax deduction kicks in July of next year, a few months of that, and then we'll kind of see how that works, and then we might see some states taking definitive moves. In fact, probably the state that might be the furthest down the road, California, is, other than Washington. Washington is definitely the furthest down the road, but the second maybe would be California. And they set up a committee to study this, a legislative committee that is going to issue a report by January of next year. So I really doubt they're going to do anything before that. And I think when the report comes out in January of next year, they're probably going to say, they're going to gear it more toward late in the year, and they can kind of watch what happens in Washington. Because there were, those of you familiar with the Washington law, there were quite a few holes. I thought, at least it's my opinion, I thought there were a lot of holes in the law, and I guess the legislature ultimately agreed, and they're using this time to maybe patch some of those holes in the law. So we'll see, kind of see what happens. Stay tuned. Certainly, if you have questions, this is something we're following on a pretty regular basis as well. So we'll let you know as things develop. But as of now, it still is going forward, but not yet. and maybe not originally as planned either. There are a few more people can opt out now than could before. So I guess the good news is too that a lot of most of the carriers who stop selling in Washington. If you do live in Washington, or if you have clients in Washington, a lot of the carriers that stopped selling long-term care policies in Washington out of fear that people would just get the policy exempt and then let the policy lapse. Well, that the date for having the long-term care insurance didn't change when they changed the payroll tax deduction. That's still, you had to have it by November 1st of last year. So they figure, well, that risk is gone now. So most of them are back. I know we're back in Washington. I think most of the most carriers are probably back selling in Washington now. If you have clients that are retired public safety employees, that'd be police, firefighter, police chaplain, ambulance, EMTs, and have worked for public safety entities, municipalities typically, or states. They can use distributions from that plan up to $3,000 to buy long-term care insurance. So nice thing about that is those are typically pre-tax money. So yeah, at least in this one instance, this category of people can really get, in a sense, tax-free long-term care, tax-free premiums on long-term care. Distribution would have to be paid directly to the carrier. Again, if the individual takes it, it's considered a distribution, it'd be taxable. They wouldn't get this benefit. But if the distribution is paid directly to the carrier, it can go as long-term care insurance. So now the partnership program, I'm not going to go into a lot of detail on this because I'm probably not the expert on the partnership program, but generally tax qualified policies in states that recognize the partnership program, qualify for that. And essentially, I don't know that it's really a tax savings per se, but it's more of an asset protection where somebody, that if somebody is going to qualify for Medicaid, if they're going to use their policy benefits and then maybe they have a short policy and they figure they're going to be in care longer than the policy, they can exempt as much of their own assets from Medicaid and still qualify based on the benefits. They can exempt the same dollar amount of long-term care benefits that were paid to them through this policy, if the state participates in the partnership program. So that can be a good, it's not an immediate tax break necessarily, but it winds up protecting assets down the road. So it's I think it's a good program. Amanda, I think you got some things to bring up here.
Yes. Thank you so much, Stephen. You offered some great insights, so we appreciate you going over that information. I want to wrap up with just a few things that you as producers can refer to after this webinar that hopefully will help you be positioned to start writing more long-term care business with us. We know that it takes leads in order to have opportunities to set appointments and write business. And so what we've recently rolled out is a new consumer-facing newspaper ad. And it's a great way for you to get your name in front of prospects. There is a way to advertise yourself within the local community with associations or even HOAs. So you can reach out to our sales support team at 1-800-693-6083, or you can email them at sales.support@mutualofomaha.com, and they can send you the digital files to go ahead and work with your local newspapers to try to get an ad running, promoting, reaching out to you for an appointment. Another lead opportunity is with our consumer video. This video is not product or carrier specific. It simply illustrates the importance of planning for long-term care. Personally, I work with several long-term care specialists who are using this video by including a link within their email signature line of every email that they send out. What we're hearing from these producers and ways that it's successful for them is that they could potentially be ending or finalizing another sale, say a life sale or a med sup sale. And at the end of that, they say, if you've not planned for long-term care, let me send you this link or this flyer. And it's an interactive flyer. They click on the link or open the PDF, and they can click on the state that they're in, and it takes them directly to the video. And so that's a great way to start generating more appointments or lead opportunities. It's also important to remember that not everyone can qualify for long-term care insurance. This is why you need to have the conversations earlier. The younger they are, the healthier they are. The younger they are, they have more affordable rates for you to work with. So remember that our policy starts at age 30 and it goes up to age 79. If you're not already illustrating our product from the Mutual Care Solutions software, and let's say you're using WinFlex or other illustration softwares to compare our rates, I really want to encourage you to take just a few minutes, get onto our Sales Professional Access site. You can do that by going to www.mutualofomaha.com/broker. It's extremely user-friendly software. If you don't know our product today, I know that long-term care can sometimes seem complicated. This software does not allow you to run a combination of policy benefits that can't work together. So it's really going to do a good job essentially of training you on the product and the product features. Of course, Katie at Premier and her team, as well as those folks, all of us at Mutual, our sales support teams, we're all here to help support your needs. But I would suggest you downloading this software. A click of a button will take you straight to our product and underwriting guide. You do not have to re-download it every time there is an update to the software. It's a click of a button. So check that out if you have not already. Keep in mind, you have 3 ways that you can write our product. We still offer the paper app. We have a fillable PDF with an approved signature vendor opportunity to sign electronically, or our e-app. I do highly encourage you to use our e-app if you have not. It's going to be the quickest, easiest way for you to get a policy submitted with Mutual and make it through the underwriting a new business process. So please check that out. We have an opportunity for you to test it out in an environment on Sales Professional Access site, so you're not just jumping into it with the client. So again, I encourage you to check that out. Now that we've kind of touched on the sales process, I've given you a few ideas. Stephen, let's jump to the next slide. I think it's important that you know that it's a statistic everybody knows out there. 70% of people who reach age 65 will need long-term care services. So I think it's important to be able to explain to your potential policyholders what the value of purchasing a policy can be for them. So I thought there was a few points here worth mentioning. We know that a person can work their entire life and be saving for retirement, and one long-term care event can wipe their entire plan out of place by not having a plan for long-term care. So as an agent, you can make a big difference in people's lives by just helping them protect their retirement and assets through putting a long-term care plan in place. I also mentioned before, people want to remain in their homes as long as possible. They want to maintain their independence. So be sure you understand the value of the policy you're selling them. I can assure you the reason our product has been on the market for as long as it has is because our product is working exactly how we wanted it to, which is how the client would expect it to work come claim time with all of the consumer-friendly benefits that we offer. A long-term care policy can help a person control their finances and their future. I wanted to share this slide with some actual numbers to help illustrate for you what that value is. So this is taking a female and a male policy, age 50, paying into a policy for 30 years, so until they reach age 80. You will see here that the amount of premium they would have paid in as a male, $38,373, and a female, $63,583. And using our cost of care data that we update on an annual basis and assuming a 3% inflation, the figure is going to be around $146,551 for the cost of care at the time they would claim. Their policy benefits with 3 years, 3% inflation would have grown to $262,141. So you can show right there that value. They've paid in $38,000 or $63,000. Their policy is now worth $262,000, and we know it's going to be around $150,000 for the cost of care, depending on, really it's different depending on where you live and the facility, or if you want home care, depending on what you're looking at. These numbers clearly do illustrate, though, that value that the consumer needs to hear from you, and helps you tell that story to your clients as well. So as you're closing sales and delivering policies with Mutual, there's another great feature that I love to promote that I want you to be aware of that we offer that I'm not aware of any other carrier offering out there, and that's our annual inflation letter. We communicate with your clients. If you've sold them the policy, they're paying premiums, they have their policy active, we will mail out an annual letter letting them know how much their policy benefits have grown to with the inflation options they choose. A lot of times consumers will purchase a policy, stick it in a drawer, and forget the details. This is a great way to remind them of the value of their policy on an annual basis. So we do that automatically. And then last, if you are not currently following us on Facebook, this is a great way to stay in touch with the best, most competitive marketing materials we have. You can search Mutual of Omaha Brokerage Sales Professionals, request to join, fill out a few short questions, and then receive an approval to join. It's a private page. So we do post new content weekly, and you can share these posts once you're approved in the group. Katie, that really wraps up all of what I was wanting to share. I did send out to Katie at Premier links to all of these tools and resources I've mentioned, so she'll be able to get them out to you after today's webinar. But we did want to open up for any questions that anyone has.
Amanda and Stephen, thank you so very much. That was so insightful. We do have a couple questions coming in. One regarding the video. So the link to be shared, and I know that you will send out that information regarding the sales team as well. But the follow-up question to that was video utilization. Can they utilize it on social media?
They can through the approved content. That's why I would encourage them. Anything that we post out on Facebook is going to be previously approved content that can be shared. And it indicates if it's consumer approved or producer approved. So that is the avenue I would suggest that folks go if they're wanting to share it out on social media channels, because if it's approved on Facebook, then it can be shared on any of their social media channels. And if they have, more specific questions on that, Katie, certainly follow up with me after this webinar, and I can get in touch with our marketing manager on more specifics. Hopefully did that answer the question? Okay.
Yeah, I absolutely think so. And if there's additional, we will reach out. Another one is regarding the annual letter. Is this available for all policyholders, including ones that have had it for many years?
So this is for our, I would have to double check just to make sure I'm confirming correctly, but it's for our LTC 09, so the policy that's been out there, the most recent policy. We had some updates in 13, but not a new policy series. So it would be our most current policy series. But I will double check that, Katie, and we can get a message out to those who are on the webinar just confirming that. And it goes out to all policyholders who have elected an inflation option. So what we're doing is we're sharing with them what that inflation has grown to from year to year.
Perfect. Another one will be, is the presentation going to be shared? I know that we are doing a recording, but they're asking specifically about the slides and the tax deductibility guides.
Stephen, I will defer to you on whether you're comfortable with that or not.
Yeah, it'd be fine. We can email the slides over to you. That'd be fine.
Yep, Katie, I'll do that. Just keep in mind on our slide deck, we do indicate for producer use only. So we would just like to make sure that it remains with the producers that are contracted with you for their viewing, and it's not consumer approved or anything like that, just as a reminder.
Perfect. Another one was, does Mutual of Omaha accept DocuSign? We
do. That is an approved signature vendor. Good question. Thanks for asking.
I think that's it. It looks like we covered most everything. And I do appreciate everyone for attending. I know that this is a hot topic. This is something that a lot of agents are calling in for regularly. And what we're going to do is we're going to send a follow-up email, including the recording, the slides, the tax guides, and also some additional information regarding Mutual of Omaha's big push on social media. So with that being said, I look forward to hearing from everyone. You are more than welcome to call me as a follow-up. I can see here that we have the advanced markets team. They're putting their number out there. So with that, Amanda and Stephen, thank you so very much. We really appreciate it. And for everyone out there, happy Tuesday and have a great week.
Have a great week,
thanks,
everyone.
Everybody.
Thanks. Bye.